Not too long ago, I myself was a beginner investor in the stock market. In other words,
I had no idea what I was doing.
And I realized that most of you watching financial channels already know the necessary and more about investing. But I also do realize that there are some of you who are starting from scratch, just like I had not too long ago. And I remember how complicated and overwhelming it felt at the time. And now, just a short end down the road, I realized that investing in the stock market is actually not that scary and quite fun once you understand it more and learn more about it. So in this video, I'll break down in simple English concepts that you need to understand when investing and where you can start as a beginner investor. So just to disclaim, I'm not a professional and I don't know nearly as much as there can be known, and there's no need for you to trust me. Just one beginner investor to another, trying to help each other progress in our financial lives. So let's start right away. First, why should you invest? The main reason you should invest your money is because of a thing called inflation. Inflation is the decline of purchasing power of a given currency over time. So for example, just an example, last year I had $1 and I could have bought a Big Mac burger with it. This year I have $1 and I cannot buy a Big Mac anymore. My dollar doesn't have the same purchasing power because a Big Mac is $1.50. Inflation. All right, so inflation is the reason why your money loses value over time, and therefore your time decreases in value over time as well. So to counter inflation, you have to make sure your money will grow. Find a way for your money to grow more than it will depreciate. For instance, if the inflation rate in the year 2020 was 2% and your investment grew by 2%, that means you only stayed on par with inflation. Therefore, any growth more than 2% would mean you are moving upwards. So any growth lower than 2% means that your time's value has decreased and is less worth than it was when you earned that money. It's not a fun idea, people. Next up, let's look at some fundamentals. So learning from other professionals, watching countless videos on YouTube, and by reading quite a few books on finance, there is a consensus or a unanimous agreement on a few fundamentals before you start investing. Okay, so first thing is pay off all your debt.
Third step of achieving financial independence, and that is staying out of high interest debt.
Phase 3 is where we pay off mid to high interest rate debts. This is your credit card debt or anything that's in excess of 10%. We will focus in on here.
You can wander into debt, darling. You cannot wander out.
Number one, get out of debt.
Basically, any debt that you have that doesn't make you more money should be paid off as soon as you possibly can.
The second step is to pay off debt. It's very important to eliminate debt as soon as you can.
Step 2, pay off your debt. About 80% of American adults are in debt, and we've just accepted this as the status quo.
And above all, I believe in you. I know it's something that you can do. Not saying that it's going to be easy, but I'm just telling you it's going to be worthwhile.
And second, have an emergency fund.
And step 6, create an emergency fund. But if you're a conservative person like me, then have at least 3 to 6 months worth of expenses saved up to cover the basics.
Step 1, create an emergency fund. Save $1,000 and put it into an emergency fund that you'll only use in dire circumstances.
It's very important to have an emergency fund. I talked about this in one of my other.
It is going to rain. You need a rainy day fund. You need an emergency fund.
That is build an emergency fund, I've mentioned many times before. And third, spend less than you earn and save more money. Because apart from your expenses, you need a surplus to be able to invest.
There's a very easy way to do this. If you make $49,000 a year, live as if you're making 27. Everybody lives over what they make. No wonder you can't save money. Your apartment's too nice.
Make the gap as big as you can. Increase your income as much as possible and lower your expenses as much as you can. Because at the end, this gap will be the tool that you can use to create the life that you want, to do the things that you want.
A mistake that I've seen between pretty much every money series, and something that for the most part all of us are guilty of on some level or another, is getting accustomed to lifestyle inflation. This is the practice in which we start making a little bit more money each and every month, and then from there we start spending a little bit more money each and every month.
So here on Mind Leaves, we're all about financial freedom, saving money, getting out of debt, and living a healthy, wealthy life. So if you need some more motivation on these topics or want to learn more, please enjoy the content on the channel. And if you like it, please consider subscribing down below and hit the bell to be notified on any new videos from Mind Leaves. Okay, so let's go. Now that you paid off all your debt, you have an emergency fund, and you have money saved up, let's quickly dive into some financial terminology to understand. Alright, so you might have heard of stocks and bonds and mutual funds and index funds and the stock market, and if it all seems overwhelming, I will just simplify them to you. So you can grab a pen and a notebook if you want to, or not. It might just make sense from the get-go. Let's go. Number one, a stock. Okay, you can buy a stock from a corporation, and this means that you own a small fraction of that company. So for example, if you buy a stock from Starbucks, you own a small share in Starbucks. All right, and usually single stock investments are seen as high risk investments because you solely put your hope in this one company. So if the company does bad, or even if the people lose their confidence in the company, they might pull out their money out of the stock market and sell their stocks, and therefore the value of the company shares drop. Thus, you lose money too. All right, the next thing you have to know is investment funds. We will look at mutual funds, index funds, and ETFs. First, a mutual fund. Mutual funds are basically a basket full of single stocks. So you are diversified and you can purchase this basket. Now, this basket is managed by a person or people actively managing the basket or the fund. Thus, you will pay more in fees because if you buy this mutual fund or you invest into this mutual fund, you pay these people as well. So mutual funds became a bit expensive, complicated, illiquid, and had many required minimum investment amounts. So then came index funds. Now, index funds are basically exactly the same as a mutual fund, except it's not managed by people. So it's not actively managed. It's managed by a formula or a computer that copies the market, follows the market. Thus, you pay less in fees. And then a little while later, ETFs became very popular. Now, ETFs and index funds are very, very similar. The main difference between an index and an ETF is you can buy and sell index funds only for the price set at the end of a trading day. So that will be more applicable to traders rather than investors. If you want to know more on that, I recommend you check out the video here where I talked about investors versus traders. Okay, so with an ETF, you can buy and sell at any time of the day. The fees are less on most of the ETFs, so it's really easy to manage. Also made a video going into detail on ETFs, so you can check that one out as well. Next one, bonds. Okay, so you might have heard about bonds. What are they? Bonds are basically a loan you give to a corporation or the government. All right, you lend them your money for a fixed period and they pay out interest to you. Biannually, annually, or quarterly. Then when the date is matured, they repay you the face value that you loaned to them in the beginning. All right, so this form of investment is seen as a low risk with a very predictable outcome. All right, so bonds can provide a predictable stream of income when stocks perform poorly, and they are a great savings vehicle for you when you don't want to put your money at risk. If you're still here, that's awesome. Consider liking the video down below, and let's continue with our last terminology, dividends. Okay, dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investments. So companies pay their shareholders every time they make a profit. Thus, you can buy some ETFs or single stocks that are more focused on their dividend payouts than others. And thus, the higher value of the stock, the higher is your dividend payout. And if the stock or ETF loses a lot of value, so does your dividend amount. And it's really important to do your research on what stocks you want to buy or ETFs you want to buy, because sometimes if their dividend yield is very high, their stock value might not be that high, and you always want your stock value to be high and your dividend, because the higher the stock value, the better your dividend payout. It is also recommended to reinvest those dividends so that your investment can have more compounded growth over time. Let's quickly look at a short example of compounded growth. Okay, let's just hop on a compound interest calculator. So we say we start off with a zero initial balance with a nice 8% yearly return on interest. We invest for 10 years with a compound interval monthly. We deposit $100 every month. We increase deposits yearly with inflation. Let's make inflation 2% yearly. We calculate. All right, and here you can see, instead of just saving your money for 10 years, you would have had $13,139. Okay, but you invested it and with compounded interest, and now you have $19,905 for your final investment value, and you earned interest $6,766. So you got more than 50% of your initial amount back in interest. And that is the beauty of compounded interest. Okay.
And the stock market is basically the shop where you can go and choose what you want to buy. The marketplace. You can choose to buy stocks, you can choose to buy ETFs, you can choose to buy mutual funds or index funds. Okay, all right, so now that we have all the terminology behind us, where can you start as a beginner investor? All right, so where can you start as a beginner investor? Just want to mention again, this is not professional advice. I would recommend first just to start. Remember, if you have no idea what you're doing, you're still doing better than half of the people who haven't even started to invest in the stock market already. All right, and then start small and get comfortable. If you have been watching my videos, I use the platform eToro. This is a very user-friendly platform for anyone to use, no matter where you are in your investment journey. All right, it also is an international platform and covers a lot of countries all over the world. So if you are interested, it's really easy to set up a profile. You can use my link down below, it will really help me out. I also made other videos on eToro for beginners, explaining the fees, etc. So you can check those out as well. Such an easy platform, it just makes you feel professional. Okay, so an easy, low-risk, simple way to start is by investing in ETFs. Now, they are low on fees, they are very well diversified, they are easily manageable, it allows you to get comfortable and then get confident. Some ETFs that I would recommend are two of Vanguard's ETFs. Now, they are particularly popular. Both of them provide exposure to the US stock market. Okay, so the VTI and the VOO, these ETFs track the S&P 500 index. Now, what is the S&P 500? The S&P 500 is an index of the 500 largest US publicly traded companies. So you are diversified over 500 of the best performing companies in the US. And just for you, I made a video going into detail on these two ETFs. I will link them up here as well as in the description below. We have reached the end. I hope that investing in the stock market is a bit more simple and understandable to you now. Tell me if you learned something new or what you found most valuable in the video in the comments down below. Thank you guys for watching. Here on Mind Leaves, we usually talk about freedom, finance, and purpose. So if you're interested in more content like this, subscribe down below. Thanks for watching. I hope you guys have a great and healthy, wealthy life. I will see you in the next one. Goodbye.